Have you ever wondered what would happen to your family if you were no longer around tomorrow? Would they be financially secure? Would they be able to keep their home, pay the bills, or plan for the future without you? That's exactly why life insurance exists. It isn't just about paperwork or policy numbers, it's about peace of mind. It's a promise that says, even if I'm gone, I've still got your back. So, what exactly is life insurance? It's a contract between you and an insurance company. In exchange for your premiums, they promise to pay your loved ones a set amount of money when you pass away. That amount is called the death benefit. Unlike other types of insurance, it's not about reimbursing for losses. It's about delivering a guaranteed payout when your family needs it most. But how do they figure out how much you'll pay? That's where mortality tables come in. These charts show how likely someone is to pass away at a certain age. And believe it or not, insurance works best when it covers a lot of people. That's the power of the law of large numbers. Now here's the thing, not everyone pays the same. If you're in great health, you'll pay less. If you have certain risks in your life, you'll pay more. That's the job of the underwriter. They review your health history, lifestyle, and even your hobbies. Do you skydive? That might raise a red flag. Why do they do all this? To avoid something called adverse selection. That happens when people who expect to file a claim try to buy coverage at the same rate as someone who's low risk. The system only works if the risk is spread fairly. Let's talk types of coverage. Term life insurance is the simplest. You're covered for a set number of years. If you die during that time, the benefit is paid. If you don't, the coverage ends. It's affordable, straightforward, and often a good choice for young families. Then there's whole life insurance. It stays in effect as long as you pay for it. It also builds something called cash value over time. That's money you can borrow against or use for future expenses. Looking for flexibility? Universal life insurance lets you change your premiums and even adjust your death benefit. It's a great fit for people whose income or needs may shift over time. But here's a question. What happens if you become disabled and can't make your payments? That's where riders come in. A waiver of premium rider keeps the policy active without you paying. A payer benefit rider does something similar if you're paying for someone else's coverage, like a child's. When the time comes for the policy to pay out, your loved ones have options. They can take a lump sum, set up monthly payments, or even choose lifetime income. These are called settlement options, and the choice depends on their needs. Let's pause for a second. If someone dies and the order of death is unclear, how do you know who gets the benefit? The Uniform Simultaneous Death Act handles this by assuming the beneficiary died first. It's designed to simplify complex situations. Now consider this. How much coverage do you actually need? One approach is the human life value method. It looks at your income, the years you plan to work, and what your family would lose financially if you were gone. Life insurance also offers tax perks. The death benefit is typically tax-free. The cash value grows without being taxed until you use it. And if you switch policies using a 1035 exchange, you can carry the gains over without a tax hit. But be careful. If you put too much money into a policy, it could become a modified endowment contract, or MEC. That changes how withdrawals are taxed and not in your favor. The IRS uses something called the 7-pay test to make that determination. Life insurance also plays a major role in the workplace. Many employers offer group life insurance to full-time employees. It's easy to qualify for and may come with built-in features like accelerated benefits. And for business owners, there's key person insurance. If your top employee passes away, this policy helps your company stay afloat. It provides funds to find a replacement or cover lost revenue. One more thing. Life insurance contracts are known as contracts of adhesion. That means the insurer writes the rules. You accept them as is or not at all. And to sign a valid contract, you must be mentally sound, of legal age, and sober. With all this in mind, it's easy to see that life insurance isn't just a product. It's a foundation for financial security. It protects families, preserves legacies, and provides confidence in the face of life's biggest unknown. So ask yourself, if life changed tomorrow, would your loved ones be ready?